Hello there, I'm Azara Tagaya and you're watching Ringgit Sense, the show where we talk about personal finance. Now on the show, we've often told you about the need to invest money early on in your life so that you can save up for your children's education or maybe even for your own retirement. But how and what do you invest in? For some, there's the option of property investment or the stock market, while some others may channel all of the money that they have into something more high risk, like cryptocurrencies. So how do you pick the right investment? With us in the studio today is Felix Neo, a certified financial planner, to walk us through the pros and cons of each type of investment. Hi Felix, thank you so much for joining us.
Welcome.
Okay, so we know about the different types of investments that you can actually take part in. So let's say, because most of our viewers are actually families, let's say it's a family, a young family with a joint income of maybe 6,000 ringgit. So what are the options for this family? What can they invest in?
Okay. I did some kind of calculations just to get a better grip in terms of what a family at that kind of a profile is able to invest. And I think it's safe to say that a person or family in that kind of situation could only have probably about $300 to $400, maybe $500 to save in a month. So in that sense, there aren't that many options to be realistic. There aren't that many options, Obviously, the first thing is to set up your cash reserve, and then after that, a lot of people want to take advantage of, for example, the ASB type of funds, building, fixed deposits and all that. So that would be the natural tendency for people at that kind of income levels.
Okay, so how much do you actually need to invest in all the different types of investments that are available today?
Okay, I think to have a meaningful investment portfolio, you probably need about 20, 30 or maybe 50,000 ringgit to be able to have a good diversification of assets. So the idea here is to build the cash reserves and continue to so-called save so-called bullets, if you like, for investments. So the idea is when you are at that kind of, when you have about 50,000 or so, that is when you can actually look for investment options.
Okay, so talking about your options, why is it important for people to actually diversify their investments, and how can you do that? In what areas do you propose we diversify? Okay,
so diversifying of investments is a very basic investment strategy, if you like, right? Simply because different asset classes will perform differently depending on the market conditions. So because we don't have a crystal ball, we want to make sure that there's sufficient diversification across different asset classes, right? So what are the common type of asset classes, if you like, available to Malaysians? You're talking about very liquid type of investments. So there's the fixed deposits, there's the ASBs and all that. Those are low risk, right? Very high capital preservation, but not much return, if you like. Then there are so-called moderate risk type of investments. It could be, for example, shares, like dividend growth type of shares, or just a balanced portfolio, 50% equity, 50% bond, that kind of split. Those are moderate risks, right? They tend to give a decent return above fixed deposit, but not really that much in that sense. But low risk, right? And then there are growth type of funds as well. So you could buy into direct shares, or you could go for growth investments. Now, somewhere in the moderate to high risk kind of space, properties are also a popular option for many Malaysians.
Yes. So speaking about the popularity of property investment and also maybe trading and stocks, what are the pros and cons of these most popular type of investments?
Okay, I'll start with the trading of stocks. The thing about trading of stocks is that you can make a lot of money quite quickly, but likewise you can also lose a lot of money. So for us, what we like to normally advocate is that if you want to be a trader in the stock market, number one, you must have the time. Right? You must have the knowledge and you must have the interest. If you have all these three ingredients, then your likelihood, your probability of making a decent return from the stock market will be better. Right? But if you don't know anything about the companies, and if you were to buy based on rumors, then the likelihood of you having a bad investment experience is going to be quite high. Now, property is the other investment that is very popular among Malaysians. I think it's a great idea simply because of the leverage that property enables people to have, right? But what we do notice is that when you're overexposed to property, they are very illiquid in nature, right? So if the idea is for you to use property and have it rented out so that you can get some income, yield and all that, the issue is that nowadays with so many properties coming to the pipeline, you may have some issues with renting out properties. You might either not be able to get as high a rental as you would like, right? Or you might have issues in terms of, vacancies, right? And if you're a long-term property owner, what you realize is after a couple of years, you need to refurbish. So there are some costs involved as well. But more importantly, for people who want to sell, it's not something that you can actually liquidate just like that. You do need to take some time to get, look for a buyer, and then there will be a lot of negotiations and all of that. So it is illiquid in that sense. So that's why we don't suggest people having too much of their investments in property.
What about if it's for their children's education? So let's say somebody comes to you and they say that they want to save up for their children's education. They may have already PTPTN. So besides that, what else, what options are available for parents?
Okay, I think it really is a function of how much they want to, allocate or save up for the child's education, and how long, would they have to save and invest. So what I mean is, let's say if you are having, your child is only 3 years old and they have 15 years to save, if you like, then, property could be one option. Or, long-term shares or, a portfolio of unit trust funds could be an option. My suggestion to my clients is always, definitely go for the SSPN 1 Malaysia, that's what they call it now, savings, simply because there's a tax relief that is allowed for that, right? But don't only put into that simply because the dividend rates are way too low. If you look at last year's dividend rates for this savings, it's only about 4%. And I think if you ask most Malaysians, they would know that the cost of education and the inflation for education is much higher than that. So you do need to look for something that's able to generate a much better return over the long term. Yes,
definitely. Okay, so on a final note, your final piece of advice to our viewers who want to actually take part in investments, what's the best way?
For majority of Malaysians, automating these investments is a very important thing. What that means is just basically diligently putting aside a certain amount into investments, right, so that you can actually benefit from all the ups and downs of the market for the long term.
All right, excellent. Thank you so much, Felix, for sharing with us on Ringgit Sense. Now, hopefully, what we've shared today is going to help some of our viewers watching Ringgit Sense today. Thank you so much.
Thank you.
Well, guys, it's time for a break. When we come back, we'll be talking more about how you can actually multiply your finances with us after this on Ringgit Sense. Welcome back to Ringgit Sense. Earlier in the show, we gave you tips on the pros and cons of different types of investments. So now let's talk a bit more about unit trusts. It's a great way to get started investing, but how do you know which fund to pick, especially when your goal is to save up enough for your child's education fund or for your retirement? We met up with Fund Supermart, a website that allows you to invest in unit trusts online, and we asked them to explain to us the basics.
We met with Jerry Lee, a research analyst at Fund Supermart, to explain what is a unit trust. According to Jerry, a unit trust is a collective scheme investment. It will gather the funds from investors like you and invest the money according to a set of objectives outlined in their prospectus. The main difference between a unit trust and investing in stocks or bonds directly is that there is a professional fund manager who will manage the investments for you. All you need to do is provide a fee to the fund manager. It's ideal for those who don't have time to monitor the stock market daily, as the fund manager will buy and sell at the right time for you.
For unit trust investor, mainly they pay two types of fees. The first one is the management and some other miscellaneous charges, and the second one is the upfront subscription fees. So for the first one, the management and other miscellaneous charges, we can always refer to the fund expense ratio to see how much an investor pay for these charges over the past 1 year periods. And on average, this expense ratio range between 2% to 2.5% for an equity fund. Whereas for the upfront subscription fees, investors need to pay about 5.5 to 6% of upfront subscription fees if they invest through an agent. But investors, if they invest through our FSM, our Fund Supermarket platform, they only need to pay about 1.75% of the upfront subscription fees.
Also, when you're switching between funds, there may be a fee charged. However, Jerry doesn't recommend switching funds frequently.
We don't encourage our investors to do a frequent switching because especially during a volatile market environment. Therefore, I think if you look at switching, if you pick a good fund, there's no point for you to do a frequent switching. Therefore, I think the key point here is that fund pickings. We need to select a good fund for your portfolio. Therefore, you don't need to incur much switching.
There are many funds to pick from, and you have to read their investment portfolio to find out what they invest in.
There are a few categories for unit trust funds, and the most common ones, most of the unit trust funds, they will be categorized according to the asset class. Therefore, we will see some funds that they will invest into the equity market, some will invest into the bond market, and some will invest into the mixture of bond and equity, where we call it the balanced funds.
So how do you pick the right fund for you? Well, it depends on your risk profile and investment goals. For example, if you're saving for your retirement and know that you have another 30 years to go before retiring, that means you have a higher risk profile and can invest over longer periods of time. If you're saving for your children's education fund and have less than 17 years, then your risk profile will be lower. As an investor, you can pick a few funds to diversify your risk to build a portfolio. You don't have to put all your eggs in one basket.
We always advocate our investor to build a systematic portfolio. Therefore, I think with this one, as you mentioned, for an aggressive investor, they can always allocate their capital, different capital into the bond versus the equity. For example, if an aggressive investor, they can allocate, like for example, 10% into the bonds and then 90% into equity because they have a long enough investment horizon and they have a greater risk appetite. So with that, investor can also go through our website to see some of the geographical allocation for bond and also for equities.
So tell me what we're looking at here.
Yeah, so if you look at fixed income, we have 4 types of fixed income funds. First one is a Malaysia short duration bond, and then Malaysia all duration bonds, followed by Asian bond and also emerging market bond. So the Asian and emerging market bond is a yield enhancement to the investor portfolio. So it will yield additional returns for investor. Whereas for equity, we separate it into 3 main parts. First one is the developed markets, followed by Asia and Japan markets, and the third one is the emerging markets. So because we also consider that most of our clients are the Malaysians, so we also put in the Malaysian markets as one of the components for the equity markets. First of all, we look at the risk profile of the investor. If you are saying that you have an investment horizon of about 20 to 30 years, and then you are able to take up a lot of risk, therefore we can classify you as a moderately aggressive or the aggressive investor. So with that, you can actually allocate your capital for bond and equity, about 70% in equity, 30% in bond. So in the equity parts, we will also separate into a few regions equities, such as the emerging markets equity, the Asia and Japan equity, so on and so forth.
Jerry says that last year was a good year for most of the local equity funds as they recorded double-digit returns, meaning that most gave returns of more than 10%, with some seeing returns of more than 20%. We asked Jerry what was the best performing fund so far over the last few years.
So the best performing fund on our platform based on the 3 years cumulative return basis for the CIMB Principal Greater China Equity Fund. So we can look at here that the CIMB Greater China Equity Fund recorded about 13.72% annualized return over the past 3 years periods. So the fund mainly invests into the Greater China region, be it the China, Taiwan and Hong Kong equity markets.
The higher the returns, the higher the risk factor, meaning that no matter what fund you invest in, there's always a risk that you could lose money.
So definitely this is the highest, one of the highest risk fund on our platform is, if you look at it on the risk category, it has a risk rating of about 8. So our risk rating, we will look at the funds according to the asset class, whether or not it is a fixed income or it's an equity fund. Then we will look at which region that this fund invests into. So those single region or single country funds, they will get a higher risk rating compared to those diversified funds.
Investors can also measure a fund by looking at its track record.
Actually, there are two types of performance that we need to look for. First one is the cumulative return, which I mentioned over a 3 years period that this fund recorded, for example, 50% of return. So that one is one criteria that we look for. Apart from the cumulative return, we also need to look at the calendar year return. This is to ensure there is a consistency of return. Let me give you an example. Let's say that there's a fund A and fund B. Both the fund recorded 100% over the past 5 years period. We might not be able to differentiate which fund is the better one. But how if I tell you that fund A recorded 100% in the first year and subsequent year it recorded 0% return, but fund B recorded 20% each year for past 5 years. So obviously fund B will be the better one in terms of consistency. So these are the criteria that we look for when we look at the historical returns.
We asked Jerry which is best for investors. Should they save up their money to a sizable amount before investing in a unit trust fund, or do it monthly with a smaller investment?
I think for most of the people, one of the biggest misperceptions regarding unit trust investment is that they think they need to save a huge amount of capitals before starting their investment. So if you look at some of the minimum initial investment for some of the unit trust fund, it can go as low as a few hundred to about 1,000 ringgit Malaysia. So my advice to them is that to start their own investment as soon as today, because this will enable their investment capital to benefit from the compounding effect. If you do a once a year time, you might be buying at a very high price because we might not know when is the peak or the trough of the markets. So if you do a money reduction, if you do your investment on a money reduction basis, it enables you to buy at a different point of price. So this will prevent the investor from investing at a higher level of price.
To sum it up, if you're looking to invest in a diversified portfolio of stocks and bonds, and you don't have the time to monitor the stock market, unit trust is the right investment tool for you, as a professional fund manager will do it for you for a fee.
Well, once you're confident about investing in unit trusts, perhaps you want to try your hand in investing directly in the stock market. Well, after the break, we're going to give you tips on how to trade stocks online. Stay with us. Welcome back. Before the break, we showed you how investing in unit trusts work. Now, however, if you're a bit more savvy and want to invest directly in the stock market, there are many who are now trading online. So how do you get started or even know what stocks to buy? To answer these questions, we met with Kenanga Investment Bank Berhad.
According to Lee Kok Kee, the Executive Director and Head of Group Equity Broking Business at Kenanga Investment Bank, online trading has been around for about 15 years. From their internal statistics, they can see that almost 2/3 of those who traded stocks conventionally were above the ages of 40. However, on their digital trading platform, it's a different story.
Within our group also, right, we have a fully digital business. Now the statistics there then is very different. 79% of my customers there who assess the market fully digital online using smartphones or iPads and all, it's 79%, right? And more telling is that 40% of them have not actually invested in the market before, and they just came on board once we launched the platform.
That means the millennials are keen to participate in the capital market, but without the hassle of going through a stockbroker.
So there was always this fear that conventional broking, because I have to call the broker, I must have a certain minimum amount for him to be able to service me, right? If I ask too many questions, he may not be happy with me because I end up investing a small amount or not even investing at all. So does this divide that people fear that, hey, I am not ready based on the capital that I have or the information that I have to invest in the marketplace. But once we have the actually online trading, we have the digital platform to serve this new millennials or the new investors. That fear, we can build a bridge to actually take care of the fear. Because then they can actually assess the market, look at the share prices online, get access to research report online, right? Track their own portfolio online, read even financial news online. That's what we have actually developed over the years in Kenanga. It's just not just an execution tool, but the entire experience of participating in the stock market via an app. which in the current day and time is people are always comfortable doing things online, from e-banking to e-commerce, or even e-hailing. So that really, I think, will be the trend in the future as well.
Investing in stocks directly is a higher investment risk compared to investing in a unit trust, as you will be making all the investment decisions. So what are the basic investment strategies that you can use as a first-time investor?
Obviously, we can't say, hey, you come online, there's guaranteed profit, right? But what we actually tell new investors is that base your strategy, start simple, yeah? Based on your strategies on fundamentals, not speculations, right? Because there are various strategies out there. One is fundamental, then the other one is technical. The last thing you want to do is base your investments on hearsay. So my advice to new investors is that participate in the market. As you learn the market, always fall back on fundamentals. If you really look at where the market is, right, what would a typical sophisticated investor or fund manager look at when they invest in a company? One is growth, growth of the company in the future. Two, which is a very important point, the track record of the management, right? I look at the track record of the management. Three, I look at relative valuation. Because even if it's a good company, it could be expensive or cheap at different point in time, right? So you have to then look at relative valuations. What is the P multiple versus the peer? How far has gone up over the time period? So you look at those things. And if you're actually a bit defensive, you could be looking at a defensive stock that look at dividend yields and things like that. So those are the fundamentals that I encourage people to look at.
Now, if you don't quite understand what Kok Ki just said, don't worry. Many of the large investment banks that have online trading also do free educational classes that teaches you the basics of trading stocks. To sign up to trade online is pretty easy as well. According to Kok Ki at Kenanga, new investors can also do it online.
Within the group, which is the Kenang group, we have actually achieved a non-face-to-face account opening where you can actually open the accounts entirely with us online. And what really you need is that you need your IC, you need a proof of your financial track record. It could be your bank statement, it could be your salary slips, and basically you fill in all those information. There'll be probably some KYC questions, which is your risk appetite and things like that. And you submit it. We will do a verification and all those things. There's a process of KYC, then you're ready to go. We try to make it as simple as possible. And then what happens is that as you go down the investment path, as you trade more and more amount, you build a track record with us, then we talk about greater trading limits and everything.
As with unit trusts, the amount you need to start investing is actually quite small.
People say, oh, what is my minimum amount? I would say that you can even start with 500 ringgit to 1,000 ringgit because the bought lot on the bursa is only 100 shares. So if the share is worth $1, that's 100 ringgit investments, right? So you can actually start small, and there's never the thing about I have not enough capital to start or I'm too young to start, because it's a compounding game over time.
The important thing is to do your research on the stocks you're buying. With online trading, the research department at the banks will send you daily in-depth research with suggested sell and buy prices for some companies. Once you've bought a stock, you can set it to sell when it reaches your target price. It's pretty automated, so beginner investors just need to spend a few minutes a day on the phone monitoring their investments. Of course, for the more savvy investors, there are more in-depth information that they can go through. With modern technology, you can now control all your investments on the go through your phone.
Well, guys, all investments bring with them a certain set of risks. So to minimize your risk, do your research. The most important thing is don't fall into the trap of investing in a dubious get-rich-quick scheme. Protect yourself with information and check with the Malaysian Securities Commission and Bank Negara to find out schemes that have been blacklisted. If you want to learn more about personal finance, go to our Facebook page, Ringgit Sense TV3. I'm Azaria Tagaya, and I'll see you in the next episode.
Boom.